The role of ALM in banking: balancing risk and reward. In the dynamic world of banking, where financial landscapes constantly shift, asset and liability management, or ALM, plays a crucial role. ALM helps banks to effectively balance risk and reward, ensuring that they operate efficiently while meeting regulatory requirements. Understanding ALM. At its core, ALM is a strategic framework used by banks to manage risks that arise from mismatches between assets and liabilities. These mismatches can lead to liquidity risk, interest rate risk, and even credit risk. By systematically managing these risks, banks can optimize returns while maintaining stability. Importance of liquidity management. One of the primary responsibilities of ALM is liquidity management. Banks must ensure they have enough liquidity to meet their short-term obligations. This involves careful planning and forecasting of cash flows. A sound liquidity strategy includes accessing diverse funding sources and predicting customer withdrawal patterns. For instance, a bank might maintain a liquidity buffer by holding a portion of its assets in cash or cash-equivalent securities. This enables the bank to respond promptly to unexpected demands while optimizing the use of available funds. Interest rate risk. Next, let's talk about interest rate risk. This is the risk that changes in interest rates will affect an institution's financial condition. For example, if a bank borrows funds at a fixed rate, but lends out those funds at a variable rate, it exposes itself to risks if market interest rates fluctuate. ALM helps banks to actively manage this risk through strategies like duration matching and hedging. By aligning the duration of assets and liabilities, banks can minimize the impact of interest rate movements on their profitability. Instruments like interest rate swaps and options are commonly used as hedging tools. Regulatory compliance. In today's regulatory landscape, compliance is more important than ever. Banks are subject to strict regulations designed to safeguard the financial system. ALM plays a pivotal role in ensuring that banks comply with these regulations, such as maintaining adequate capital reserves and adhering to liquidity requirements. Effective ALM practices allow banks to demonstrate to regulators that they are capable of managing risks proactively. This not only protects the bank from regulatory penalties, but also enhances its reputation in the market. Capital allocation. A significant aspect of ALM is efficient capital allocation. Banks must determine how to deploy their capital effectively across different assets while considering associated risks and returns. By using ALM models, banks can project various scenarios related to asset performance, helping them to make informed decisions on where to allocate their resources. This strategic allocation of capital not only aims to maximize returns, but also to enhance diversification and lower overall risk exposure. Scenario analysis and stress testing. Another critical component of ALM is scenario analysis and stress testing. Banks often analyze how different economic conditions could impact their balance sheets. By projecting various scenarios, banks can identify potential vulnerabilities and proactively develop strategies to mitigate them. Stress testing helps banks understand how they would perform during economic downturns or financial crises. This fortifies the institution's resilience and supports regulatory compliance as policymakers increasingly require robust stress testing procedures. Technology in ALM. With the rapid advancement of technology, ALM is evolving. Many banks are leveraging sophisticated analytics tools and software to enhance their ALM processes. These technologies assist in real-time data analysis, risk assessment, and reporting, ultimately enabling banks to respond swiftly to market changes. By incorporating technology into ALM, banks can gain better insights into their risk profiles, leading to improved decision-making and more agile risk management practices. Conclusion. In conclusion, asset and liability management is vital for banks striving to balance risk and reward. Through effective liquidity management, interest rate risk control, compliance, and capital allocation, ALM equips banks with the necessary tools to navigate financial complexities. With ongoing advancements in technology and a heightened focus on regulatory compliance, the role of ALM will continue to grow, helping banks to build a more resilient and sustainable future. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.